what is W2, what are W9 forms, what is 1099, what is form 941. I don't know if we have discussed this, 941 and 940 forms. So we'll cover these two, but these three we covered, right? W2 form is a payroll slips kind of thing, like payroll summary, which is equal to form. W9 form is equivalent to PAN card. 1099 form is actually again form 16 but for the contractors. So India, we have two different forms. We issue form 16 for the employees as well as for the contractors, for which we issue 1099 in US. 941 and 940 forms are separate forms. In US we file two different forms. 940 forms are filed on the yearly basis, and this is filed on the quarterly basis. So basically what we do is in the 941 form is equivalent to what we file in India as well. So last time we discussed that whenever we deduct TDS for any of the employees, we need to submit it to this income tax department. How the income tax department will know what TDS was deducted and for whom, right?
Auto-file to software.
Which one?
941.
So if you are using any of the softwares, it auto-files the forms itself every quarter within the due date. But if you are running the payroll manually, if you are doing the payroll manually and the software, we don't use any software, then we need to file it online with this federal tax website. That form actually contains the details of how much taxes we deducted, what was the gross salary, and all those details that we use in the W2 form. Okay. Now coming back to the 941 form, I'm going to correlate this with what we have in India so that you can understand like what we are doing in here. So quarterly we also file TDS returns with the state, with the income tax department in India. So that TDS return actually has the details of all the employees, their PAN card, amount that I paid to them, and then the TDS deducted and I deposited. So that is equivalent to what we have in the 941 forms. 940 forms is actually the yearly form, which actually the total of all the forms that we have filed in 941 during the quarter. So that is a summary of for the whole year that we filed in the state. Okay. A couple of other variations. So last time we understand the simple journal entry of payroll the tax deducted and there was a benefit, but we will also discuss what are the pre-tax deduction and the post-tax deductions. So there are two terminologies being used in payroll for US, which is pre and post-tax deductions. Okay. So the pre-tax deduction actually reduces the income of the employee. So for example, how we have ATC, right? ATC everybody knows, it's kind of if you are paying to the LICs an insurance premium, it reduces your salary. So if you have a salary of 10 lakh rupees and you paid 150,000 as an insurance premium, your salary will reduce to 850k. The taxes will be levied on these. Same we have pre-tax in US, which is pre-tax deductions. That would be your benefit that you contribute, all those things that would be covered in here. The post-tax deduction is actually that does not reduces your salary, but it is actually part of the adjustment or we pay as part of the salary. So that could be anything like the garnishments, which is what we paid in US, and then if there is any reimbursements that you get, these will not reduce your salary, or the deduction that, let's say someone broke the office laptop and I want to reduce the salary. So it will not reduce your actual salary for the tax purposes, but it will actually reduce your salary just because you will be getting paid less amount. So these will be two differentiation between the pre-tax and the post-tax. Okay. I think we also discussed 1099 form last time, but we did not discuss what are the different type of forms that we have in 1099. So there are the three major forms that we file: 1099 MISC, 1099 NEC, 1099. These are the basic three forms. There are separate multiple forms, but these are very generally used terms or generally used forms that we file. So NEC actually includes the non-employee compensation. So any contractor that you are paying which is not your employee, then it will be covered in here. Okay. The limit is again $600, 600 or above. is what it will be covered in here. The 1099 MEC which you cannot cover in the NEC, that will be covered in here, and they have specific boxes to be checked. So like you have, I think you have box 1 for rent, then we have royalties, and there are separate forms that you can include in here. So if you are paying rent to an individual or a partnership, not to the corp, not to the C corps, but an individual and partnership, it will be filed under 1099 MSC, not in the NEC. Okay, so that is the major difference. It has a specific rent, royalty boxes that you'll need to be checked and include that amount in those boxes. For 1099 NEC, if you are paying to the contractor, it will be covered in here. The 1099 interest, if you have taken a loan from a bank or any financial institution, and they are paying an interest, and you are paying an interest to them, it will be income for them. So they will be filing a 1099 INT for you. Okay, so that will be for the interest part. Now, what are the other things? Any specific question that you have for these three?
So amendment I think is right.
So that is actually 1099 NEC amendment that will be applicable from next year. The limit will be increased to 2,000. Okay. Right now it's $600 that we will be filing it for. Okay. Now, I think that's basically what we are doing in the 1099 form. There are a couple of things that we also need to take care. The due date of filing the 34th is 31st January. But there is no such rule which says that you are supposed to file everything, all the 1099 forms by 31st January. Even if you don't, there is no penalty. But that brings another question, then why does IRS wants you to still file the forms on before 31st January? And that the reason is because the individual's tax return is due on 15th of March. Okay? If I file that tax form, which is let's say on 16th March, if I file the 1099 on 16th March, then it will not be reflected in their tax return because I filed it after the due date. So to be able to have the individuals or the partnership have the correct data when they file their tax returns, we should always try to get all the 1099 forms by 31st January. Let's say if you file this by 15th March, individual actually file his tax return, and on 16th March you actually filed a 1099 for them, which they did not include in their tax return. What will be the repercussions? The repercussion will be on the company who filed the 1099 form late. They are supposed to deduct taxes on that amount that they paid to that employee who did not declare it in their income. So then the liability will fall to the entity itself who actually delayed the 1099 form. Understood? So that is the basic reason for why we do the 1099 form before 31st January. Okay. Now there are ways to calculate the 1099 forms, and different software uses different methodologies. So like in Xero, we have a feature called 1099 reporting. I think that's what it's called under the reporting section. That is basically calculates the 1099 amount for you. What you need to do is you need to select what are the GL accounts that you need to cover in here. So let's say I want to select repairs, I want to select contractors for 1099 NEC. Then it will also ask you, so these are the conditions that whenever you create 1099 report, it will ask you a couple of conditions. So what are the 1099 NEC GL account will be covered in this form, and then you will select, let's say, rent 1099 and then interest for 1099. The moment you pull in these records, you will be asked to select the year. So let's say I am selecting the year 2025, and it will automatically create the 1099 working for you for all the vendors. The condition is that you should be selecting the right vendor, right contractor while you are doing the categorization. If let's say you have selected unknown as a vendor name, then it will capture unknown as a proper vendor, and it will ask you to file the 1099 form. The problem is whenever you select unknown for the vendor name, and let's say you paid a contractor which was 500 that you put into the right vendor account, but the $200 was actually went into the unknown vendor. then what 1099 will show, that report that is generated in zero, that not applicable, form is not applicable for this, and same for this. But if you had the right vendor name for these two, it will be at $700, which is what you paid, and it will say that it is applicable to you. So it is very important to select the right vendor whenever you categorize anything. The second thing which Xero does, and subconsciously we don't know why it does this, and the reason is not the reason, but actually what it does is it automatically excludes the transaction that you paid to those contractors using your credit card, PayPal, or any third-party platform except your bank account. So it automatically excludes those transactions, and that's what we need to do. The reason why we are doing it is because those platforms which we are using to pay those contractors is going to actually file the 1099 for them, right? So let's say if I paid someone $700 using a credit card, what the credit card company will do is they will file a 1099 form for that contractors. Let's say if I also file a 1099 form for them, so what will happen is IRS will know that these employee or contractor actually got paid twice for the same amount. So then it will create a mismatch for them. So instead of doing that, we will be avoiding those things, right? There is no certain rules. There are always ambiguity whether this is the right thing to do or not. But actually, basis on our understanding or history or the discussion that we had with the CPAs, it is normally what everyone is doing. But there is no such rule to do that. It is still our responsibility to make sure that we file a 1099 form. But if the credit card company is doing, let's say PayPal, we are using PayPal. If PayPal are doing, then we should not doing it. So technically, so what we have taken a decision is that we will exclude all the third-party platform while we are filing the 1099 forms. Only the bank that we are using or the cash that we are paying, that should be covered in the 1099 form. Okay. So I think we only have like 10 more minutes, but I'll quickly cover the sales tax here. Generally, we are not doing the sales tax accounting, or sorry, we are doing the accounting but not the filing. So we'll limit our concepts related to the accounting, but it is very important for us to understand what is sales tax, how it is applicable, why it is not applicable for most of our clients. So there is basically one thing which is important that we need to understand, which is called nexus. So how India has a limit for a service provider of 20 lakh rupees before they can have their GST registered, right? That is a mandatory limit. If you make your turnover service revenue more than 20 lakhs in the financial year, you need to get yourself registered, right? That's what then basically the nexus is. If your threshold is above a certain transactions or an amount, so there are two different conditions to actually calculate. First, before we go to the condition, there are actually two ways to calculate the nexus. First is actually physical location, and the second is based on the transaction. That also has two conditions. It is actually a number of transactions or an amount threshold. Okay. So if you have a store, warehouse, any kind of or plant in a state where it says that you need to pay the taxes, if you have a warehouse where you are making sales, or if you have a godown, or if you have a whatever the scenario is, then the sales tax will be applicable. So that every state in US has a different sales tax rule, right? Some of the state does not levy a sales tax even if you make a sale or you have a physical location there. But some of the state actually levies sales tax if you have a physical location in that particular state. If that condition is, let's say, not applicable for you, then we'll move to the second condition, which is based on the transaction, and it's either or. So it's not like either this plus this, it's actually either this or this. So then next is based on the transaction. There are a couple of conditions that we need to say, and these are also either or option, right? Not combined. But if you have a certain transactions which is above a certain number, so let's say some of the states says that if you made a sale of more than 200 times in that year, then the sales tax will be applicable. Or there will be an amount threshold which would be like if you made a sale of more than $200,000 in a year, whether it is only one transaction, then still the sales tax will be applicable. So that's how we calculate the nexus. Now we use different software to do that. We are not doing it because there are different sales tax rate including for each and every county as well. So county is like small town. Like Gurgaon has multiple small towns, so each town will have its own sales tax number, own sales tax nexus calculation. So we use a software to calculate that for us. We don't do it ourselves. Otherwise, it will be very difficult for us to do it. So let's say that we have a sales tax applicability. Now, how to do the accounting is basically simple. That's normally how we do for the sales tax.
So at the time of registration, we have to choose this is the physical location or this is based on transaction.
So there are, whenever you meet any of these conditions, you will need to select, you need to get yourself registered, and at the time of registration of sales tax return, you need to choose the option why you are actually getting yourself registered. Okay. Now the sales tax entries, which are like really simple, how we do for the GST, that's how we will do for the sales tax in here as well. So let's say you made a sale of $1,000 and you charge a 9% sales tax on it. So what I'll do is, let's say if I made a sale on credit, not on cash, so I'll do AR debit. So that would be my sale, because that's how I made the sales for, and that is actually a sales tax liability that I'm collecting from customer and then I'm going to pay it to this state. So that will become my liability. Okay. Well, sales tax liability. Okay, so this is the entry that we will be posting. Now let's say we got the money, so the entry we will be posting is bank debit to AR, which is 1090. Now we got this liability payment from the customer, so now we need to pay it back to the state. So the moment we pay it to the state, we will do sales tax liability account debit, which is 90 to bank. Understood? So this will cross off your $90 liability with this payment. So the balance sheet will show zero. Okay. They don't have the input concept, which is like really good question. So like in India, we have couple of options. So in here, if you have paid a GST on something, you can take a credit for it. Okay. And what does it mean? The input tax credit is what we call. So let's say I purchase a 100 rupees item. Let's say for our service, someone is actually giving me a professional service. So what they will do is they will charge me 100 rupees for their revenue, and they will also charge an 18% GST on top of that. So what I need to pay to them is 118 rupees. Now how I will be doing this accounting, because this 18% GST that I paid, I'm allowed to use that as a credit to pay off my liability. So I paid it to the customer, to my vendor, that I can take a credit when I actually invoice it to my customer. So how we will do the accounting for that is, so we'll do a purchase or professional fees debit, because it's a service industry. So I'll do is 100. I'll create a GST receivable debit. So that becomes my asset the moment I pay it. So that will be 18, and then to vendor account. Okay, 180. Now let's say that I receive these services from vendor. Now I'm going to make a sale. So the moment I make a sale, what I'll do is same entry. We will do a AR account debit to sales and to GST payable. Okay. So I made a margin of, let's say, 50 rupees on it. So I made a sale of 150. I charge 18% on it, which would be 27, and that would be 177. Okay, so now I have a GST payable of 27, but I already paid an 18 rupees GST when I actually received that service. So what I'm going to do is, I'm going to post another entry which would be GST payable debit, so that 27 to GST receivable, which would be this 18 that I'm going to adjust my liability. So I'm reducing my payable balance by 18 and to bank for the difference amount. Now let's say who has actually, so this sale I made to someone else who will also be doing the same thing again and again. So that's how we use the input tax credit at the time of sale. Okay. Any questions? Yeah, close.